So, welcome everybody at this new meeting on the financial line seminars. It's a pleasure to introduce today's speaker, Luca Ferrazzoli, who serves as a bank resolution advisor in the Resolution and Crisis Management Unit of the Bank of Italy. Luca brings with him extensive experience and deep expertise in the field of financial crisis and their resolution. So, not surprisingly, the title of his talk is Crisis Management Framework for Banks in the European Union. And I'm very much looking forward to hearing his insight on this very important topic. As always, following the presentation, we will open the floor for discussion. So please feel free to ask questions by raising your virtual hand in the Zoom menu. And thank you again. Once again, Luca, for accepting our invitation, and the floor is yours.
Emiliano, thank you very much for inviting me. It's really a pleasure for me to share, some insights, and some experience, and also explains to people that are not, let's say, in the field, how bank crises are managed, and how it is done in the EU, but we will also, make some comparisons and some hints, on how it differs from the, let's say, US, Switzerland, Japan, and other jurisdictions, also to understand, how the different feelings and the politics, behind the decisions. I will speak about how the resolution and crisis management, especially for banks, work in the EU. But on this, I will also try to give some hints, on how it works in other jurisdictions. For example, Switzerland, the US, and try to make you understand, how the different decisions, are based. I will start, from the big financial crisis, that we had a few years ago, maybe 16 years ago. And from them, I would like to walk you through, how this new framework has been built, why, and how it works, and what is not working, and which are the challenges, and way forward that we have. Because, as you know, the crisis management, especially for banks, it's a very important topic that when things are going well, maybe it's not the most fancy topic. People do not talk a lot about it. But when something goes wrong, if there is a crisis, it really becomes crucial and extremely important for the public and for everyone, because the consequences, of a crisis that is not managed well are very, very important for the public, for the government, for the taxpayer, and for every one of us. So I will start, saying, sorry. So, okay. So everyone knows, that in 2008, there was the crisis of Lehman Brothers. Let's say a big crisis that had also the collapse of Lehman Brothers. A very big bank, an important US bank that was not saved. By the US government, by other peers, by anyone, and so it collapsed. And it was really a shock for the system. We had other banks that fail globally. Market losses were unprecedented high. The government in the US, but also in the EU and across the globe, had to intervene, in order to bail out banks, using, of course, the taxpayers' money. And it has a very big impact. Here it emerged, also the concept of banks that were too big to fail. So banks that were so big that its failure was not acceptable because they were very interconnected with other financial institutions, and the contagion effect was extremely high. This is why, the government and all the public institutions have to bail out and intervene in order to also save other banks, because otherwise, let's say the issue could have been so much worse. The this crisis, at the end we have seen that lead also to a very big problem, on also government spending. The debt GDP ratio raised quite a lot because lots of public financing were used. And then in we had also, as a consequence also of this, a sovereign debt crisis, that it also led to some economic crisis, recession, GDP contractions, and several issues, in several member states, that even lost market access. It was an unprecedented crisis, and it leads, the G20 to meet and to establish, let's say, the Financial Stability Board. That is a board, reporting to the G20, that it had the mandate also to define some rules, financial rules, in order to, among others, manage bank crisis, in a better way. Try to set some standards, because the experience for Lehman Brothers also shown that if the creditors of the bank, would have been involved more, let's say the cost for the public would have been less. And in addition, going back to this point of the debtors, let's say that if we let know, the shareholders of the bank, the bondholder of the bank, that if something goes wrong, there is someone that is going to bail out, there is not really an incentive to monitor. And it was an issue. And this mandate to the Financial Stability Board, was also to, try to find, let's say, a way to overcome this issue. So, in summary, the great financial crisis, shows some shortcomings. Among what I already mentioned was also, the banking supervision, for example, and the crisis management in Europe, that were completely left to the single countries. So the practices were different, the certainty was different, the tools were completely different. So we didn't have a, let's say, single banking market in Europe, but there were different banks supervised by different authorities in different way. Then, there were also a lack of effective tool to deal with the crisis. Because, for example, let's say in Italy or some other countries, we also had before, some very effective to manage the crisis of a bank. In Italy, we had a long history of crisis, and we managed them also ensuring sometimes the continuity of the bank, using some private fund in order to help the bank to absorb losses. But in some European countries, there were not, so in some other countries in the world. And in addition, there was the need that emerged, and it was clear after the big financial crisis, of the need of preserving the financial stability without bailout. So the goal was to make the public not so much involved in the save of the bank. On this, as I said, there were the Financial Stability Board on mandate of the G20 that after a few years of work in 2011 published the FSB key attributes for effective resolution regime for financial institutions. That had the goal of what I was saying now. So setting out some rules in order to try to manage the bank crisis and also crisis in a more ordered way and without bailout, but preserving the financial stability. That it was the key. The recommendation of the Financial Stability Board, are not the value of law, but it's a kind of soft law because the country, agreed on something, and then with the, let's say, aim to implement the recommendation of the Financial Stability Board in the different jurisdiction. In the European Union, there was adopted a directive that is called the Banking Recovery and Resolution Directive, with the goal, let's say, of implementing the SRB, the FSB key attributes, into the European Union. And then, in the banking union level, for those who does, so no, in Europe, we have an European Union that encompasses, say, a certain number of countries, and only part of this country, decided to join the banking union. So the ECB as a central bank, the euro, and as you will see, the common supervision and the common crisis management. So, for the banking union, for a subset of country, mostly the EU country, also a single resolution mechanism was established. The goal, was what we mean, have a way to respond to the financial crisis in a credible way without the involvement of taxpayers. Here, as I was mentioned, having a focus on the banking union, in order to tackle the issue that we told above, it was established a single supervisory mechanism. So the banking supervision for, let's say, the biggest bank was centralized at the ECB, of course, with the contribution of all the national supervisory authority that work as a team, with the final responsibility of the supervisory board of the ECB. On the same side, also the crisis management of significant and cross-border banks, so banks that have, let's say, subsidiary in different EU countries, was, let's say, granted to the single resolution board with the contribution of the national resolution authority as Banca d'Italia, in which I work. And then the goal was also to establish a common deposit insurance scheme. On this, I would like to have a short focus, in order to explain you what is a deposit insurance scheme, why it is important, and how it works. So the deposit guarantee scheme, that we also call DGS, is, let's say, the insurance on a certain amount of deposits, and it has, several different functions. The first is to, let's say, make bank run, less probable. Why? Because let's say in Europe, deposits are insured up to 100,000 euro. So if I have a bank deposit of 50,000 euro and my bank is failing, I mean, I do not have the pressure to go to the bank and withdraw all my money, because I know that up to 100,000 euro, they are safe. They are guaranteed by the scheme. So it enhances the depositor confidence. It preserves the financial stability also, because there is no, this, let's say, bank run. So, I mean, it minimizes the probability and the also the extent of a bank run. And it also minimized the cost of a crisis. Indeed, let's say that in the crisis that we experience, we saw, that the deposits from households in general, I mean, in the past, they were quite stable. So they were not, let's say, extremely important outflows, to some news. How it works in the European Union? As I say, it's up to 100,000 euro with some exception. For example, if you are, I don't know, some money that you need for medical care, to buy an house, there could be higher for some specific cases. Let's say the DGS has 7 working days in order to give you back the deposits, which is good, but it's not, let's say, great, because maybe, if you, let's say, need to make an expenses in a very short run, you need to pay for your new car, you have a debt that you have to extinguish, you have to buy something. 7 working days could be a problem, because maybe your money could be freezed. So it's still a problem, but still, that you will have, some access to your money after a few days. And of course, there are also some ways, if needed, to make the people who needs, the possibility to withdraw. I mean, some small amounts, for some specific reasons. Then, these DGSs now, they are tested. There is an authority that is in charge to verify if they are properly working, is the Bank of Italy in Italy, and they are national, and it could be private or public. In Italy, is private, and it's contributed by the banks. So the banks put some money that goes into the DGS. Of course, the DGS, do not have the resources of all the covered deposits or the covered deposits, so the deposits that are guaranteed. But of course, there is a certain amount, and then there is the possibility also to go back to banks and ask for for more amounts. Here in the US, for example, the amount is higher, is $250,000, so it's significantly higher than in Europe. And what we have we have seen, with the crisis of Signature Bank and SVB Bank, that the US, decided to cover all the deposits without limit. So it was their decision in order to restore confidence, avoid bank run. And it's something, let's say, that in Europe, it would not be very easy. It will not be very easy also because, the rules, they are agreed among different countries, so many countries. The decision-making process is more difficult. And let's say the crisis in a country could not be, the crisis of another country. And this is also something that we have seen why we do not have a common deposit insurance scheme in Europe, because sometimes, let's say the sharing of the resources, it's never, very, very easy to be understood also, especially at the political level, because I said if a German banks fail, maybe Italian, Spanish, or Luxembourgish taxpayer, not taxpayer banks may not be happy, to pay also for a failure in another country. In Japan, differently, they have a different scheme. So they ensure deposits that are side deposits, let's say deposits without interest that, let's say, they are used for daily payment without limit, but then there are some limits on other categories of deposits. So different countries, took different approaches. After the crisis of the US bank, there were some studies at the international level, the Financial Stability Board, FDIC, at the European Union level. And after this analysis and this study in EU, it was confirmed that 100,000 euro could be enough. There will not be an incentive, to increase this, at least at this stage. So going back to the crisis management framework in Europe, as we have seen in line with the SB key attributes, the cornerstone of the new framework are this one. I will focus on the most important one, just to make you understand the logic. So one point that I want to mention before is that this framework, it applies only to, let's say, the significant banks. So banks whose failure may have an impact on the financial stability or may have contagion effect. So it's not for all the banks now, this framework. The framework that we've seen before at the Financial Stability Board, it's, let's say, mandatory as a soft law for the global significant institutions, so biggest bank in the world that are considered too big to fail. Then, it was up to each jurisdiction to decide, to follow this FSB principle also for other banks or not. The European Union, let's say, has a wide scope of banks for which this has been implemented. In the US, for example, SVB Bank and Signature Bank, were, let's say, were subject to not the same, to, let's say, less strict rule than the one that we have in Italy, for bank of that size. So in Europe, the cornerstone of this framework are ensure the continuity of the bank's critical function and maintain financial stability. What does it mean? It means that as that we do this job, every year we work with each bank in order to do a plan to manage the crisis. So we have a plan for each bank to manage the crisis. And when we do this plan, we try to understand which are the function of the bank that should be kept continuous in order to preserve financial stability and avoid contagion effect. I give an example, for example, when we have banks, let's say UniCredit in Italy or Deutsche Bank in Germany, Banco Santander, that let's assume that they have 10-15% of the market share in the country of lending. If they stop doing lending for one day to another, it may lead really to a contagion effect and impact to financial stability. Why? Because they may not give lending to enterprises. For these enterprises, it's not easy to substitute, the bank with another bank in a short time. And so, it may lead to a contagion effect. So this function should be kept in continuous. The same to happen to deposits. Let's say that if a bank holds a large part of deposits in a country, if they stop making the function of deposits, many people could not be able to pay, and it may lead to contagion, fear, and so this function should be kept continued. Then, the resolution authority have more intrusive power. So we have the power to sell the bank without approval of the management body, also keeping the bank continuous. We have the right to, let's say, write down shareholders, so equity and debt, and to convert also debt into equity. So this leads also to no bailout. That is one of the goals. I would say no bailout. Maybe it's a very ambitious goal, but the idea is to absorb losses as much as you can from inside. And then also, if this condition is not met, this public interest is not met, the normal national insolvency procedure will be held. In addition, for each creditors, we should make sure that if we apply this resolution, so this new tool, it should be no worse off than in insolvency. This is also so no one should be worse off. So what we do every day, because this, I think the very big paradigm shift, that we have this with the new framework is that okay, we don't manage the crisis. So when we have a crisis, we manage it. No, we plan the crisis. So a resolution authority was established in the EU, but also at the national level. And I would say that it was established also in, most of the G20 countries that adopted the FSB key attributes. So, there is also in Switzerland, in the US, etc. And the idea is to plan. So in going concern, even for banks that are going very well, we plan. The banking supervisions, they do plans to understand, all the recovery options that the bank can apply, if they are not going well. So if the bank is approaching the crisis, banks themselves are required to prepare some recovery plans. So a series of recovery actions studied in advance that they can use in order to restore the viability. And we, as resolution authority, we prepare this resolution plan. So the plan to manage the crisis. We try to understand where could be the problem, and we work with the bank in order to overcome those problems. And this is we do every year in a continuous basis. And this is also right, for the main bank also in the US, in Japan, maybe with different means, because in Europe, it's the authority that prepared the plans. In the US, is the bank, but still is review with the authority. Then when the stress situation arises, the banking supervision can adopt a series of actions, that can arrive to the removal of the management body and use several supervisory actions, in order to try to restore, let's say, the soundness of a bank. If it is not the case, there should be the declaration of the failing or likely to fail. So it's when the bank is failed and we can start the resolution. It's important to stress why it's called not only failing, but failing or likely to fail. Why? Because if a bank is close to fail, sometimes it's better to intervene. Because, the point of this declaration is crucial, because if it's declared too early, maybe it's possible that we are going to resolution of a bank that could have been restored by itself, with no resolution actions. But the more we wait, the more resources of the bank are burned. So at a certain point, if we see that there is no way for the bank, we should start the resolution action or the normal insolvency proceeding. On here, I will go quite fast. I just wanted to give you some hints of what we do in this resolution planning every year. So every year we try to understand, which are the main strategies to resolve the bank. We have a list of possible tools, that I already briefly explained, but I will be more in depth later. We identify that if there are some obstacles, we ask the bank to remove the obstacles. And then, we also do this public interest assessment that I was saying before. We try to understand if the bank has some functions that are critical, and And so if we have to apply this resolution or not. And so, it's really a sounding and ongoing work that we do together with bank in order to make sure that banks could be, let's say, resolved easily. Here, I just wanted to remind you the conditions for this resolution to apply. So the bank should be in failing or likely to fail. That could be, let's say, given by the banking supervision, or in some cases even by the resolution authority. And it means, that the bank, let's say, is not sounded anymore. The capital requirements are not respected, and there are some serious issues from the bank. Then the second condition that is very interesting, that there should be no alternative private sector measures. So the idea is that if there are private sector measures, it's always better to use them. But if these conditions are met, then there should be the analysis if there is public interest or not. This analysis, as we said, it is performed already during the planning, so we do it every year, but we have to perform it also before the management of the crisis. Why? Because we know that banks are institutions based on trust. If there is no trust on the banks, the banks could really fail and lose lots of capital and liquidity very, very quickly. So this is why that maybe a situation that was assessed 1 year before, it could not be the same at the point of a crisis. So this is a quite important point. And then we decide, if go for this resolution or this normal insolvency proceeding. And the goal of all of this is not to save the bank. This is, I think, one key point, but is to ensure the continuity of the functions that are critical, so to avoid the contagion effect, and also to, let's say, protective public funds. So having way that the crisis is mostly, if not all, paid by the shareholders and the creditor of the banks. Then the tools, that the resolution authority have, let's go back. The bail-in, I already mentioned what it is. That is the possibility to write down and convert equity and debt, aiming at placing, so the burden of the crisis to the shareholders and creditor, and not having someone outside to bail out. The bail-in could arrive in theory up to the deposit. So even deposit holder in theory could become shareholder of the bank. They could be written down and converted. This is not very likely, but in a very severe scenario, it could happen. Then there is the sale of business. As I mentioned, the possibility to sell asset and liability for the bank or the whole bank without the approval of the management body. Then there is the possibility also to have a bridge institution, so to move part of the bank, of course, in case the critical economic function, so the function that should be preserved, to a new temporary bank, partially public owned or totally public owned. And there is also the possibility to have an asset separation tools, so to transfer some asset and liability, usually bad asset, to an asset management vehicle. So the principle of this resolution action that are important. This is true, let's say, in the EU, but it's also aligned with the FSB key attributes. That is, the shareholder of the institution bear the first losses. And this here the logic is clear. The shareholders are the owner of the bank. They are the one who benefits also from the upside, and so they should be the first to pay the losses. If we see it in Switzerland, the Credit Suisse crisis, I don't know if you have followed it, but there were, let's say, some discussions on the point that some debt holder, in particular that 81, let's say, subordinated bond holder, they bear some losses, before the equity holder. It was done, let's say, because there were some contractual provisions in the 81 of Credit Suisse, and because for Credit Suisse resolution was not applied. So the framework, defined by the FSB key attributes was not really applied. But there were some statements, for EU authority, also from the European Central Bank, that in Europe it will not be happen. So in Europe, shareholders pay first and then creditors, according to their ranking. So the subordinate creditors pay before and then up to the senior creditor. Why is that, and which is the benefit? On this, we also get in theory, the benefit of monitor. So the debt holder of the bank, have more incentive to monitor, how the bank is managed. Because let's say, when a bank it is in a crisis, the equity holder basically they have an incentive to risk. They have a call option in theory, because or they lose everything, or they can have some upside. But the debt holder has a different way. They need to monitor the bank, and so in case the bank is not going well, they can also ask for higher rates. So for them, it's more difficult to go to the market, and they can also have some action. So this is the logic. Then after resolution, the management board are replaced. So management body and CEO in general, and a special manager could be appointed, and usually is appointed if the entity is not failed. Before taking this resolution action, of course, it's important to measure and understand, how much is the losses, and it is done by an independent valuer that is, let's say, appointed in order to estimate the level of losses. Let's say, here we go to the finance, of this crisis. We mentioned the bail-in, that is possible, let's say, to restore some capital of the bank, because if the bank they have some losses, these losses are solved, could be absorbed to the bail-in. And for this goal, banks are requested to keep a minimum requirement of own funds and eligible liability. That is more of the capital requirement that are usually requested to banks. So being simple, to banks is requested also to keep some debt that could be bail-in in case of a crisis. And it depends also from the riskiness of the bank, and from there are methodology. And this minimum requirement for own funds and eligible liability is true in Europe, but also on the at the FSB level, so G20 level, it has been implemented a TLAC, the so-called TLAC, the total loss absorption capacity. So the GSIB, so the too big to fail bank, the very big bank also has to keep a level of liability in order to absorb losses if needed. However, the let's say financing arrangements in Italy, so the liquidity in Italy, in Europe, let's say in Italy and in Europe, is, let's say, it's a pain point for Europe. We have seen in the US, for SFUB signature bank, but also in Switzerland, that the central bank and other public institutions were able to provide liquidity guarantee, provide some support, some liquidity. This in Europe is a little bit more difficult because there is a single resolution fund that is a fund that was, let's say, took in place for this purpose to help, let's say, crisis. But the condition for that now it reached full capacity, but the condition for its usage, they are not very, very, very simple. Also because they are shared resources among, let's say, all the banks of the banking. And so, the rule for use these single resolution funds are strict. So, in Europe, it's more difficult to provide, let's say, important liquidity and guarantee. In addition, this single resolution fund, it's up, if I'm not wrong, to 1% of the covered deposits of the banks, or around 70 and something billion euro. That is, of course, a significant amount, but may not be enough in case of a systemic crisis. So it's, let's say, still ongoing discussion of having a public backstop with the European Stability Mechanism. So in Italy, the famous MES, but it was not completed. So this is a pain point that we have in Europe, but maybe it's not let's say, true for all the jurisdiction. Now I wanted to briefly, show you how the governance for the let's say resolution of a crisis works. To make you understand, how complex it is, because you have, on the let's say top left, the banks is failing to fail that should be declared. Then we have, the single resolution mechanism, let's say, that should decide, if there is public interest or not. And then we have to decide, how the crisis should be managed. And then all this package should go to the European Commission, that is in 24 hours should endorse the scheme or object. And if object, it should be modified. And if the European Commission object to the decision of the single resolution board on the public interest and on the use of the single resolution funds, it can go up to the EU Council. So, you see how this scheme is complex, and how us as authority, we really have to prepare, because all this procedure should be done, say, over a weekend, or definitely less. So we have to be prepared, to each scenario. And this is something, that is, I think, complex in Europe. Now, to mention some recent crisis case we have in 2015 for remember in Italy, for, let's say, less significant institutions, so not very big institutions that failed simultaneously. And even though it was, let's say, a little bit before the approval of this EU directive, it was in the middle, so it was quite difficult to manage that crisis for this reason. But seeing how the effect even of a not very big bank, could be important. Then we have a crisis, Banco Popular, acquired by Banco Santander, that it was sold. Now, it's not here, but there were, these two Venetian banks in Italy, for which there were two second institutions, but the public interest assessment was negative. So it was managed, let's say, according to the national insolvency proceeding. And then we have Sberbank, recently Russian banks, that due to the sanctions, the two, let's say, European subsidiary failed, and it was a liquidity crisis. And then we have in other jurisdiction, for example, the crisis, of course, Signature Bank and Credit Suisse. Each of these crises, they are all very different crises. Let's say, for example, the US banks, they had unprecedented deposit outflows, also due to their specific business. Maybe for the four banks in Italy, it was different. For Credit Suisse, let's say the reasoning behind was different. Just to understand that each crisis is different, and our job, is to be prepared to tackle, all the different possible solutions. Due to some of this issue, in Europe, we are working in order to revise, the crisis management framework and deposit insurance scheme. And the goal, is also to have some more common rule to small and mid-sized banks, because as explained, this resolution is also for the, let's say, banks that where there is a public interest. So there should be contagion effect or some other issue. Here, the goal, is to also expand, the number of banks for which we can use, let's say, common tools in order to save them. In addition, as they do in the US, in the US there is the FDIC, that is the authority in charge, has the possibility to use, let's say, the DGS that I was mentioning before, the resources of the DGS, also to support and finance the resolution. It was possible also in Italy, before these rules, which is the reason behind, I am a DGS, if a bank fails, I have to repay all the covered deposits. If I can intervene before the failure of the bank, with less resources than the resources that I will have to put in, in order to, let's say, repair the actual crisis, I could use some of these resources to manage the crisis better. And for example, these are private resources, so it could be a very useful tool that it was used in the past, and now the idea is to make it more flexible. because in the next years it's very difficult to use this very, very important tool. And then of course there is the idea of expand this deposit protection and make it a common European deposit protection. Maybe to close, let's briefly mention the additional challenges that we have. One, of course, is how to manage the liquidity driven crisis. So ensure the availability of public liquidity that banks can access as a last resort in case of resolution. Liquidity outflows could be very, very fast. Liquidity crisis could happen even though there are no big solvency crises. And in Europe now, as I was mentioning, it's quite difficult to tackle these liquidity crisis scenarios. In addition, also the legal issue in the execution of this bail-in, because I was mentioning the bail-in about the EU framework, but we don't have to forget that some of the big banks, they also issue lots of liability in the US, for example, or in other jurisdictions. And we have to make sure that these tools are implementable also in other jurisdictions. And also we have to make sure that crisis of cross-border institutions that have subsidiary in different countries, continents, could be managed, in an easy way. Here, there are lots of forums at institutional level in which we participate. We have the crisis management group for large banks when authority for all the world join. We have Resolution College in Europe, where all the European authorities, Ministry of Finance and DGS supervisors, among others, join in order to agree on how to manage the crisis. But this is always a complex work. Another point on which we are working a lot to make a biggest range of options available during a crisis. So increase the optionality of tools that we can use. Because as I was mentioning before, each crisis of a bank is different. We can prepare as much as we want, but we will never know in advance the scenario that it will materialize. So it's important that the authority prepare in advance as much as possible and have a, let's say, flexibility of tools that they can use in a very, very short times in order to overcome the crisis. And then the last issue that is quite important, that was also linked with the crisis of the US bank, enhance the responsiveness to deposit outflows, which are accelerated by new technology and social media. What we have seen, for example, in the US, there were banks of the Silicon Valley, so lots of venture capitalists also that have a deposit there that were working with them. So people, very technological people, and we have seen how deposit outflow could be very, very fast, also due to the point that now it's easier for each of us to make even instant payment or to make deposit transfer from our mobile very easily, and also social media. That the rumors on social media can really spread some news, and this news, there are lots of studies that are correlated, with the deposit outflows. So these are, even though studies are ongoing, so we do not have a precise indication of how is the impact of technology and social media, but we have seen that it's something to monitor that now, but also in the future could have always some more, could be more important and could be managed. And it makes even more important to prepare for a crisis in advance, because we will not have lots of time, but crisis should be really resolved in a very, very short time. I finished. I don't know if there are any questions.
Thank you very much, Luca, for this very rich talk. And so, yes, I guess I have questions, but I don't know if there are people coming from the audience willing to do questions. Okay, I see Giuseppe Donadeo. Thank you, Giuseppe, for being with us today.
Hello, can you hear me?
Yes.
Okay, thank you. Well, first of all, thanks for this interesting webinar. It was really interesting to be here. And yeah, I actually have two questions, mostly about ethics and the impact on ethics in the assessment you make. First of all, about the ethical questions and issues among bail-in and bail-out. Because of course, the aim of the analysis is to protect the public interest, basically. But how do you exactly determine the public interest? Opting for, bail-in would mean that people in charge in the bank are encouraged to control more. But on the other side, the depositors or even shareholders who have no decisional power could be affected by other people's choice, while through a bailout procedure there will be less control, of course, less push for control, but these people will not have to pay for other people's choices. So is this some kind of factors that you keep in consideration when doing your analysis or not? And yeah, the second question is about unemployment. Do you want me? Okay, the second question was about unemployment as an effect of bank crisis, and just whether you consider that in your assessments and how much it weighs. Thank you.
Okay, so those are two very interesting questions. So let's go at the first. So the way we see it. So I understand your point. Let's say with the bail-in, we make some people pay that are mostly the shareholders, the depositors, and it could be the depositors, instead of the bailout that is the general taxpayers and the general government. Let's say, in our view, the shareholders, of course, they are the owner of the bank. So, they have the right also to appoint the management body of the bank. And so, they really participate to the shareholder meetings. So in general, I would say that the shareholders, they have a control of a banks. Of course, we perfectly understand that, let's say, the minority shareholder. So if I buy some stocks of Deutsche Bank or Santander, I do not have any real power. But how this is tackled is to, let's say, information. So now in Italy, the action that we have done is to, let's say, we made lots of formal recommendation to banks to not to sell the bank stock to public or to not investors. Now say banks now, at least in Italy, they mostly do not sell their own stock to their clients as it was happened before. The same is the true for subordinated bond and even senior bonds. Now, the rules and the information that is given to the public is more strict. Let's say for the subordinated bond, usually there is a minimum amount of the bond that could be brought. That is usually for the let's say for the subordinated is 500,000 euro. So it's not something that let's say normal people or say normal savers could buy, because even if you have a few millions, you will not spend 500,000 people on a single bond. And even for the senior bond, the rules for bank to placing it to investor and to clients, now it's so much more difficult. The problem that we had in Italy, with the 4 banks, that failed, that I was mentioning before, there were lots of contagion effect because it was not the case. There were lots of clients, not wealthy clients, that were also shareholders and were subordinated debt holders for the bank. And this debt from the bank was perceived as kind of risk-free. So some, let's say, old lady, were bought this subordinated bond of a banks, thinking that they were risk-free. And it was something that in the past was quite common in Italy. There was also some mis-selling. Now what we are trying as the Bank of Italy, as you, but also as Consob and some market authorities, to make it so much more difficult to mis-selling, to inform the public, and to make sure that the people that will buy this kind of liability are, let's say, aware investors. This, of course, is not something that you can do overnight. For some years, let's say, I can talk in Italy because I know very well the banks in Italy, but many of the banks did not issue any debt to retail and to client. Now they are doing it again, but they are doing it mostly to wealth individuals. So now there should not be, let's say, someone who invests all their saving in a subordinated bond as it was happening in the past. So this is the way that we tackle. So with this procedure and this action, we do not see, let's say, the equity holder and the subordinated debt holder as, let's say, people who are not able to monitor the bank. And of course, they are so much more able than the general public and the taxpayer, because the government do not control the bank. So the government can step in if there are many issues, if there is the need to save the bank. But before save the bank, in my view, it's really important that people who gain from the bank will pay first, because the equity holder, if things are going well, they can earn lots of money, as we've seen in these years. And even this subordinated debt, you expect now the market is going well, but before, when they were going so well, we asked them these resources also paid lots of interest for this subordinated. So at the end of the should, the message that if you can gain, you can also lose. This is the first question. Regarding, let's say, the employment, of course, this is also a very important topic. This is, let's say, not in the direct mandate of the authority to make sure that the employment is kept as an high level. But of course, usually from the analysis that we have done, if to do this resolution is if we make the bank continue acting, I do not think that the unemployment or the, let's say, necessary to lay off people could be worse than in insolvency, because insolvency could be very difficult. In Italy, for example, when we have, of course, a culture of protecting the employment a lot, in the bank crisis that we have, the impact was extremely limited. We have seen with the Venetian banks that were not resolution. Of course, it was insolvent, but let's say the impact on employment was very, very, very limited. But also, the point is also to avoid the contagion, because as I was mentioned, banks are institutions that I think they survive on trust, because they have a mismatch in asset and liability. So if there is no trust, if people do not trust the bank, if everyone go to the bank and ask for their money back, the bank will fail. Any bank, even the most solid. So our goal is also to try to, let's say, make crisis, less probable and less intense. I don't know if I answer your question or if you need some further clarifications.
Thank you. If I can just say thank you for the questions, and no, it's pretty clear. And thanks again for the webinar.
Okay, there is also Lisa willing to ask a question. So thank you, Lisa.
Yeah, okay. Yeah, thank you for this talk. And I wanted to pick up on the issue of investors, who are investing in the bonds of the bank or buying equity. And I understand you're gearing it more toward institutional investors and qualified investors. But is there a worry about institutional investors who would be buying bank bonds or bank stocks on behalf of retail customers, perhaps in some kind of retirement fund. And I don't know much about how retirement funds work in Italy, but I would be worried that, an institutional investor is investing on behalf of a less sophisticated retail customer, and then that customer could be harmed if the bank gets into trouble. So you could maybe just say a little bit more about how this works.
No, this is a very, very good point. So I would like to say something before, is that if there is a bank crisis, if there is a crisis, there is someone that has to pay. So if you have a big loss, you need someone who bear for this loss. That could be, let's say, equity holder, debt holder, government, or whatever. Of course, institutional investors are mostly pension fund, also in the US, because they have lots of resources. But here, and so they can bear losses. They can have these losses. But here, the idea is that while a retail investor do not have the knowledge and do not have enough diversifications, maybe to monitor a bank, an institutional investor that have really lots of resources, they invest, on so many different banks and so many different sectors. So if there is the failure of a bank, of course they could be affected, but it should be in theory a very small percentage of their investors, or the investment. So the direct, let's say, impact on their client should be limited. When the impact could be enormous if there is a contagion effect and the systemic crisis, because as we have seen with Lehman Brothers, the big problem was the lack of confidence. If people start having lack of confidence in the financial system, so everything could collapse. So having said that someone has to pay, in the view of, let's say, the Financial Stability Board, the European Union, let's say that the pension funds that manage lots of resources, they have professional managers, they are more aware and they are educated on how to allocate their investments, and they are the ones who can really monitor the bank, because they know it. And so maybe if they see a bank that is very risky, they can move the resources from one bank to another. But if you say there could be losses also from some other, say from the pensioners or someone else, yes, but the idea is to limit the impact on the public. Of course, make this impact to zero is not possible if there is a crisis, but the goal is to make crisis less probable. And in these ways, if we can give more confidence to the market, the crisis will be less probable and less intense.
Okay. Thank you. Maybe one quick follow-up. Is there an issue about including bank stocks then in index funds or ETFs? Is that something that would be limited?
I think now it's not something that is, let's say, that is under control. Most index funds and ETFs, they are very diversified. So we are not talking a concentration on a thing bank. Was what the big issue? One bank, maybe there is an issue with one bank, and we had in Italy, as I was mentioning before, with this for banks, people having, let's say, all their savings in bonds of a certain bank. Then if the bank fails, it's really a problem. With ETF, let's say in general, it has not been, let's say, investigated a lot, this issue, because usually ETF are very diversified. So if I invest, I don't know, in an MCA world, but even, let's say, the Italian index, for example, the weight of banks, is quite high. But at the end, the weight of a single bank, is not something that can really destroy the saving of someone. Then, of course, if you invest in financial instruments, there is always a risk. This is no doubt. But and this, I think, is something that could not be mitigated 100%. If someone invests in a stock or subordinated bonds. So there are some instruments that are, let's say, basically risk-free. Even though now, if you have seen also the government bond by the Fed, they offer quite high interest rates. So now, the concept of risk-free is not, it's also changed, but the idea here is to avoid the concentration to a single bank of unaware investors and not properly diversified. Then if you are diversified and you want to buy a subordinated bond of a bank, it's, and with a very small percentage with an ETF, I think maybe there is no point, in obliging people not to subscribe it.
Okay, thank you.
So thank you very much, Luca. And maybe we have time for a last question. If you have time, I don't know. Maybe I have a question for you. It's probably it's more curiosity than a proper question. It was about, I was impressed by your comparison of the US system and the European Union system. And so if I got it right, the European system is more fragmented. And it seems fragmentation can be a way of interrupting contagion. I was wondering if, in this sense, can be, under certain circumstances, more robust than the US system or not. And in case, what are the circumstances? So I don't know if it's clear, if I made it clear.
Yes, maybe. So I will try to answer. I would say I'm not sure about it. Why? Because, say, the fragmentation in Europe, okay, it means that maybe on average we have smaller banks. We have maybe the US banks, the US they have more the market is very, so in this sense, let's say that in Europe, the failure of many banks that are smaller, maybe do not have such a, so in this way, maybe Europe is less easier to manage bank crisis than in the US. But on the other ways, what was many banks are also connected now. So even in Europe, there is the contagion effect can and of course, European Union, we have some common rules, but we are not the same country. So, the sharing of resources and some decisions are based on compromise, as you may know, because in the US, let's say the system is more homogeneous. So they've been integrated for a longer time, and also from a political point of view, that they have one central government and that is stronger. They have one only central bank that is very strong. In Europe, of course, so I work on all the different technical, let's say, network or team in charge to prepare policy and new proposals. And the idea is that in Europe we have banking systems in different countries that are a bit different, because we have a different story. If we see, for example, in Italy and in Spain, we had also in Germany so many small banks that now I think they are disappearing a lot. We are going to a concentration. Maybe Netherlands is different, and so for us it's a little bit more difficult to have common. So we find common rules, but some of these common rules are compromised. And so if there is an issue in a specific country, it's more difficult to intervene in a very strong way as they do in the US, because the US, they have a strong market, they have a let's say strong also country identity, they have a single government, a central bank that is let's say more free to take some decisions. In Europe, of course, there are different countries, different routes, different expertise. This is true, I think, in this area, but also, we have seen in so many other areas of the European Union. So let's say, for example, this EDIS, this common deposit insurance, it's something that is not been agreed yet. I think it's something that at technical level it's needed, but maybe we take more time. But I think it's also a culture matter. So I would say that in Europe, maybe banks are on average. So maybe some crisis of some banks could have a lower impact, but the tool that we have in Europe, Santa, it's more difficult to manage a crisis in Europe than maybe in the US, in Switzerland, or in other countries, because the interests are not. I mean, could not be the same, and of course there are European institutions that have some very strict rules, and they have to follow those rules because there were an agreement among different countries. I don't know if I answered your question.
Yeah, no, that's very clear. Thank you. And of course, I mean, I was trying to find a silver lining for EU. And of course, when you are so much integrated, like in the US, you are faster and stronger, intervening around the crisis, and so it makes you, I mean, more reactive. And so, okay, but that's perfect. Thank you. It's very clear. I don't know if there are other questions. Otherwise, we can stop the recording here, and thanking again Luca for his time and for sharing his insights. And thank you very much, Luca.